off the recording. So, well, thank you all for joining us for this session here. We're excited to have you join us for another session of our larger innovation series. This is our 13th session that we put together, and we're excited to have Bob Crimmins, one of the general partner of Startup Haven Ventures. And our discussion today is about capital strategy using groundwork and growth. So if you're not familiar with me or the Carlson Center, my name's Cameron Law. I serve as the executive director of the Carlson Center, and we serve as a regional hub and platform for providing approachable and accessible entrepreneurial education, community, and support to enable startup founders of all backgrounds to start and scale their businesses. And we offer a variety of ways in doing that. This is part of our workshop series to kind of connect you to best-in-class experts and thought leaders. And joining us today is Bob Crimmins. As I shared, he's the general partner of Startup Haven Ventures. We proudly will say he's a Sac State alum as well, and got his bachelor's in philosophy from Sacramento State. So we're excited to have him back, albeit virtually, and was just in Sacramento as well for a conference. But just kind of like in introducing him, one of the things I saw on his LinkedIn that I thought was really powerful, especially with kind of the mentality of being of service to founders, was he noted, and hopefully I don't steal any of your thunder on this, Bob. So, but on his LinkedIn shares, most good ideas are not also good businesses. And your job as an entrepreneur from day one is to figure out how you make a good idea into being a good business, right? And all of that is really tackling your core assumptions and really understanding the needs of your customer, and are they willing to pay for what you're trying to create. And then lastly, which we fully subscribe to, is, startups are hard, and it's a team sport. And, as he put it, it takes a village to raise a startup. And that's really led him in his journey to being an advisor, mentor, an organizer, and ultimately launching Startup Haven Ventures. So we're in good hands today, and I'll turn it on over to Bob for our discussion here today. So thank you for being here.
Well, thank you very much, Cameron. I appreciate it. I'm really, really happy to be here. As Cameron mentioned, I'm a Sacramento native. I was raised there. I've been in Seattle for, I think, about 30 years, maybe a little more. But I was a Sac State alum, philosophy of all things. I was a software engineer by background, I was originally a software engineering major, then discovered philosophy. I already had a job as a computer programmer. I just shut down the CS major and switched over. Eventually ended up in Seattle to go to grad school, University of Washington in philosophy. Was supposed to get my PhD. I got the master's and then got distracted in startups. And I got recruited to be the CTO of a startup in Seattle. And that was the end of that. I spent the next, I guess it's been now 23 years in the startup world in Seattle, founded 4 venture-backed companies, 5 or 6, depending on what you count as venture-backed, but have a lot of scars, arrows in my back and the rest of it from that experience. Have always sort of ended up in some way or another teaching whatever it was I was doing, including philosophy and scuba diving and other things that I've done. And I always wanted to help other founders and learn from the things that I had experienced, and so ended up as a mentor for the Techstars program for now 13 years. I was very involved with them. In 2006, I accidentally started a network of founders and investors by inviting them to have dinner and to play poker. I wanted to learn how to play cards, and just started asking people I was having meetings with if they wanted to get together with some other folks, have dinner, and just see if we could learn how to play poker. And that was a lot of fun. And I learned how to play poker. But what I learned and what I was most surprised by was what happens when you get founders and investors around a table for a couple of hours and let them compete with each other and trash talk and get to know each other. And so I decided that I wanted to just keep that going. So I kept that going. And as I said, now it's been going for 17 years. I'll fast forward through all the roller coaster ride that was, but now that we have 2,300 founders and investors in 11 cities right now. We're launching in some more cities too. And it was always a passion project, 10 or 15% of my time while I was being a founder, just something I did to give back to the community that had helped me. And it was very, very rewarding to see the impact that bringing founders and investors was having. So I didn't want to stop doing it. But in about 2017, 18, I had to do my next thing. And it was either going to be start another company, join a founding team, or maybe start to focus on investing. I was doing some angel investing by then, and didn't want to give up this thing that was so satisfying, so rewarding to do, and figured out a course I could chart that would allow me to continue to support this growing network. By that time, I had certainly created a rock I could no longer lift, and it didn't make sense for me to keep it going unless it was effectively going to be the last thing I ever do in my career. So out of that was spawned we have an accelerator program, which we launched in 2019, and the venture fund we launched in 2020. And we're raising fund 2 now, and it's been a terrific experience. Along the way, it's hard to do something for 23 years and not learn a couple things. Partly my own experience as a founder building venture scale companies, but also going very deep with literally hundreds of companies from Techstars and 500 startups and YC about the things that they were dealing with and trying to help them navigate their course. I just got to see a lot, and I'm really grateful for that experience. Even though they weren't all my problems, vicariously, I learned about and in many cases felt the problems that they were experiencing, and that led me to think deeply about the patterns that I saw in the things that I thought that I had learned that were most relevant to companies at different stages. And in about 2014. I had been having lots and lots of coffee meetings with founders. I was probably having 100 coffee meetings a year, and I would notice this sort of same pattern from them and from me. In the earlier days of my mentoring advising, there was a lot of, oh, can I get your feedback on something? And I'd say, yeah, let's have coffee, and then it would just be a mishmash, a wandering conversation to cover a lot of ground. Oh, so here's, and I would ask questions and they would answer them, and we'd just have a dialogue just about their startup. It wasn't really very highly focused. But over time, I noticed that what I cared the most about was what is the thing that they need to do next, the right next milestone that they need to achieve in order to unlock something next for the company. And I was a founder too, and I was a technical sort of product founder, and I love building stuff and I love product. I was the CTO of the first couple of companies, but eventually sort of got over that and became the CEO of the last couple. And as a product founder, I love talking about my product and how I was going to solve the problem, and how I was, the technology and the stack and the UI and the experience and the integrations and all these things, and why that was so important. We were doing that differently. We were doing that in the right way. But in the end, what I discovered was pretty much the product doesn't matter. Unless you're doing hard tech, deep tech, like really, really, really deep tech, the product probably isn't the thing that's going to make you successful. What's going to make you successful is navigating those first few milestones that you have to reach to develop a business that, at least in the beginning, looks like it could be sustainable and then eventually scalable. And that really comes down to, for a venture scale startup, which is unlike other kinds of startups, which, by the way, I'll just, as an aside, so everything that we do, Startup Haven, is venture scale. There's no small businesses, no lifestyle businesses, no consulting services businesses. It's all venture scale. It's not at all because I think venture scale is better. It's just different. The problem set that venture scale founders have to solve for is a different problem set than every other entrepreneur on the planet. All those other entrepreneurs, they're entrepreneurial heroes for sure. They're badass. They're building something important, but they're probably never going to have to raise $10 million. They're probably never going to have to hire 100 people in 6 months. Right? They're probably never going to have to figure out how to, build international scale. They're never going to have to do those kinds of things, and those are the things that make venture scale entrepreneurship hard. And so, by bringing founders and investors who all In fact, for Startup Haven, we even have a vetting process. If there's an application, you have to be working full-time on a venture scalable company. You could be bootstrapping, but the company has to be in principle venture scalable. And you have to have some elements of traction, of commercialization, something, you have to have done something. Quitting your job at Facebook is not the entry point for Startup Haven. So we look for a little bit of something. So that problem set, one of those problems gets solved by figuring out how to navigate the early funding landscape for that kind of company. And so this capital strategy that we're going to talk about today is the way we take that framework that started in 2014. I'll finish that story. I was walking around, and if anybody knows Seattle, there's a lake there called Green Lake. It's in the middle of the city. It's about 3 miles around. It takes about an hour to walk around it. Very, very, very popular place to just take a walk. So I would have founders meet me for a walk around Green Lake. That gave them an hour, and we would talk. And I've noticed myself getting impatient. I figured after 5 minutes, I kind of knew the product, I knew the market, a little bit about the team, kind of the elements of the product that I needed to understand to see if I could help them with what was going to come next. And I would start asking the questions about the business, about the market and the customer and the go-to-market and the channels and things like that. And the founders most often didn't want to talk about that. They wanted to talk about the product. They wanted to talk about the thing that they were building and how it was unique. And differentiation is certainly important. You should talk about your product. You should get your product right. It's just that getting your product right isn't the thing that makes you successful. Lots and lots and lots of great products fail because the business, as Cameron alluded to, one of the things that I find myself sharing a lot with, I even gave this, I'm in Vegas right now for a conference. My Uber driver last night was chatty, and so we were chatting. He found out I was in the startup world, I was an investor, and he was very keen to ask me questions because he had ideas. And at the end, he asked me, so what's the one piece of advice you would give me for when I'm starting out? And I gave him exactly the advice that Cameron cited, which is the world is full of good ideas. Awesome, genuinely good ideas. 1,000 people in a room. Who thinks this is a good idea? 1,000 hands go up. Is it also a good business? That's unknown. That question is a different question that needs to get solved in a different way. And those ideas that are really good, they don't come stamped with a little logo at the bottom right corner of the idea that says this is also a good business. You have to figure that out. And I will correct you a little bit, Cameron. It's not that you have to make your idea into a good business. Some ideas just fundamentally are not a good business. They can't be made into a good business. It's important for the founder to understand whether or not the thing that they're passionate about is the kind of thing that can be a venture scale business. Maybe it could be a lifestyle business, it could be a small business, it can be a project, maybe it turns into a nonprofit, who knows? But for it to be a venture scale business, that's a different problem set. You have to think about that differently to know whether or not this thing that everybody agrees should exist in the universe. Everybody agrees, they want it, they want to use it. They think it'll make the world a better place. That's not the criteria for a good business. That's the criteria for a good idea, right? So in figuring out the criteria to assess whether or not the idea is also good business, you have to do some math. And in those conversations I was having with founders, after 5 or maybe 10 minutes, I felt like I knew enough. Now I wanted to ask questions about, okay, where do you need to be in 4 to 6 months? On what day? What's the milestone you have to reach? Because they're all pitching me for investment or having me help them figure out how to raise capital. And the way investors think about things, they think about things differently. Lots of investors are different. And they think about many different things. But one of the things they think about is milestones. And when you raise capital, you're raising capital to reach a milestone. You're not raising capital to move the business forward and just to get it to some next place it will be on a hockey stick. Venture scale startups very, very rarely raise one round of funding. In fact, if you raise one round of funding, most likely you're not really a venture scale company. You're going to be some other kind of company that can be super awesome, great company, good for you, good for all your employees. You're creating jobs. You're going to create a good lifestyle for yourself and your employees. That's terrific. It's not a criticism. It's just a differentiation. So if you think about the company, if you're building something that's big enough, that's going to be in principle interesting to venture capital investors, then that kind of a thing, it's going to be bigger than you, and it's going to require a team. And often it's the case, not always, but often it's the case that you have to grow the team, the product, the marketing, and the rest of it ahead of your revenue that you can make on the product, right? And so that means you're going to raise funding. And when you talk to investors, it's important to understand that they're looking at you in terms of a lot of things, but if they put their capital in you, especially in the earliest stages, will you be able to take that capital and reach the next strategic milestone for your company that will allow you to raise that next round of funding? So if they think, you're really early, which is the biggest problem with early startups, is they're just too early. If they give you $500,000 or $1 million, can they see line of sight, clear view, oh, if we give you this, you're going to do these things over this amount of time that will put you in a position to raise your next round? Because if you show up needing more funding and you haven't hit a milestone that's important to those next investors, it's very, very hard to raise capital. It's hard even if you hit the milestones. Raising capital, this environment's one of the worst I've ever seen, so it's super, super hard right now. But even in good times, raising capital is hard. And having that milestone approach allows you to understand better where you need to be, so that when you show up, and what we recommend is you should look like, and you should know that you look like, a top decile company to whatever investor you're pitching to. And you shouldn't pitch to every investor you can find. That, I think, is a myth, and it's harmful. You should know, when you're pitching an investor, why they would find you interesting, and that there's something relevant. There's something about you that's relevant to their history of investing. If you're doing a CPG company and you're pitching an investor that's never, ever invested in a physical product ever, it's all been platforms and SaaS and whatnot, you're going to have to be ridiculously remarkable for them to make an investment in you. Can it happen? Sure, it can happen. It does happen sometimes. But if you look deeply into that, it's usually, there was some sort of personal relationship, or there's some other X factor that doesn't have to do with that company or that founder. There's some other thing that you can't manufacture. You can't control it. Investors, by and large, angel investors are a little, obviously, have broader interests than funds and VCs. But even angels, they kind of know what they understand. The smart ones don't try to invest in stuff they really don't understand. And you can look at their portfolio and you can have a conversation with them to see, are you the kind of company that they would recognize out of the gate? Wow, you're actually interesting to me. I recognize what you're doing. I understand it. You're at the stage that I care about. A check of my size would be the right check for a round like yours. The team is a team that I recognize as the kind of a team I like to invest in. Some investors will never invest in solo founders. Some won't invest in companies with more than 3 founders. Now that's a subtle thing to try to figure out just by looking at their profile on Crunchbase or some such. But you should know, for every investor that you're going to pitch, I look like something they recognize. They've invested in things similar to this before. When I have the conversation, I won't have to educate them about my market, my customer, my problem. Those are the people that you should pitch. Serendipity happens. You're at a networking event, you meet an investor, you're having a good conversation, they want to know more. They've never, they've heard about what you do, but they don't know much about it and they want to know more. That's great. Have a conversation. Maybe they like the cut of your jib and they decide to take a flyer. That can happen. But mostly that doesn't happen. Mostly what happens is investors kind of know what they like to invest in. And it's not impossible, it's hard, but you got to do the work. It can be hard to figure out for any given investor. They invest in, I'm at the healthcare conference in Vegas. If somebody showed up here with some marketplace for CPG products that had nothing to do with healthcare, they'd have a really hard time here. These investors, they're here because they invest in healthcare. So when one of the fundamental elements of capital strategy is knowing who you look like a top decile company to. Remember too, investors see minimum, active investors see minimum many hundreds of deals a year, 300 to 500 deals easy. If they're an active investor and it's what they do, they'll see 300 to 500 deals easy. A very active investor, especially a fund investor or VC that gets a lot of incoming. Angel investors, sometimes they hide a little bit. They're more opaque. It's harder to find them sometimes. But VCs, they have a website. People know about them. They'll get more than 1,000 incoming deals a year, and they're going to make 7 investments. So if you don't look like at least the top 100, how are you ever going to get their attention to be one of the 7 that they invest in? So it's in everybody's interest, and especially the founder's interest, not to spend too much time trying to pitch investors that won't recognize what you're doing, and that you can't tell a cogent story about why you would look like a top decile company to them. So that's the first lesson: is know who you're pitching to, find those investors that you can, and we talk a lot about cogent stories, and we're going to talk more about cogent stories here in a minute. That cogent story should be the kind of story, like if you were to tell, I see Rick's on the session here. Rick, if a founder explained to you, we're going to pitch this investor, and this is why we think they'd be a good investor to pitch, someone like Rick should be able to say, yeah, that makes sense. That's possible. You might look like a company that they would invest in. If Rick says, you know what, I don't see it. They've never invested in you at your stage with your round size and your valuation and your traction, be careful. That might be a waste of your time. And it's not just the minutes of the day, it's your mind share. Founders, when we're in fundraising mode, it's super hard. It takes 70, 80, 90% of the CEO's time to raise money. You have a conversation with an investor and they say, oh, I love what you're doing. Like, let's talk. Immediately, like, okay, I got one on the hook. Like, now how do I follow up with them? And, do they have all these stuff that they need? And, you're waiting for them to follow up with you. And investors take a really, really long time. They're ridiculously busy. Imagine getting 1,000 incoming that you have to sort through in a year. Like, that's a lot of time. You then, as a founder, are thinking, all right, yeah, I've talked to a bunch of investors and I got these ones that are interested. You go back and you tell your partner, oh, yeah, I had a great conversation. Someone like Rick could probably, assess that pitch, how it went. You could report through it. Here's Rick, I'm not volunteering you for everybody to call you. I'm just saying any experienced investor who's friendly, who you can go to and say, hey, I just talked to an investor, here's who they are, what they invested in, and they really like what we're doing and they want to learn more. If you can't find someone, advisor, mentor, investor, who would say, oh, they're a good fit for you, that could be really good, then it's probably not. So there's these sort of apocryphal stories, founders who pitch 100 investors before they get their first investor. And the story that gets told is, see, it's hard. You got to talk to a lot of people, you got to pitch a lot of investors. But if you pitch 100 investors, that took you months. My guess is the first 20 investors thought that you were unfundable because you were too early, or there's some fundamental problem with your pitch or your team or your product or your market, and there's something you hadn't figured out yet. They give you feedback, you make it a little better. The next 20, the pitch is better, the deck got better, the idea is better, you learn some things. They're like, oh, okay, good, but they're still not going to invest. You're still too early, they're not the right investors. Fast forward, 90 through 99, you started to look interesting, not because it took that many, it's because you had 6 months to make the business better, to get through the investors who weren't a good fit, to find the ones that might be a good fit, to get your business with a little bit more traction, to adjust your pricing model based on the feedback of investor number 47 and number 62 said, there's this other distribution channel you should think about. And you're like, oh, that's actually a really good idea. And you worked it out and like, oh, that's now part of the company. Personally, and this doesn't mean it never happens, I've mentored and advised hundreds of companies. I have never, ever seen a founder that pitched 100 investors. And the reason they had to pitch 100 investors is they had to find like the right investor who finally got it. That's almost never the problem. The problem is you were unfundable by 99 investors. And over time, you got better. The market changed, your product got better, you got more traction, the team got better. Lots and lots of things can improve over time. And then you found the investor who saw that now you were a company that was fundable. Meanwhile, you lost 6 months of working on the company when you were in principle probably not fundable. Now, it's not science. This is not math. You can't say I'm fundable or I'm not fundable. And if I'm not fundable, then I shouldn't raise. Mostly, if you can't find mentors and advisors who can confirm for you that you are absolutely fundable for these reasons, for those investors, with that round size, at that valuation, and that check size, with that much revenue, that's how you find an investor. So, the apocryphy in all this is that we get lucky sometimes, right? We find that investor who believes in us. We're early, pre-revenue, often, and somebody makes a bet on you. And I'm super happy when that happens, but it's not a strategy. At some point, if you're going to actually run a fundraising process, if you're going to raise more than friends and family, or maybe the very earliest angel money, where nobody is really investing in the business, they're investing in you. That you need to talk to lots of people who will fundamentally understand what you're doing, but they're going to like you and they're going to want to support you. That's the very, very earliest fundraising, and these rules don't often apply that early. But if you're running a round that's your pre-seed round, and you're raising for a specific amount that's more than a couple $100,000, and you're using something like a safe note or a convertible note or something, if you're running that kind of process, you really, really need to filter, and you need to find all and only those investors who are going to be worth your time. Because even though you might eventually raise, if you take the scatter shot approach, it's hard to quantify the impact of having lost 4 to 6 months of the CEO making progress on the company, on the things that investors actually care the most about, right? So finding that right fit and if you're not already, you should be using data to do that. Relationships are great. You can use LinkedIn to triangulate a bit. If you are using relationships, be sure that you ask, really, really pointed questions. If you want introductions to investors, first of all, the worst person to ask for an introduction to investors is another investor who's not going to invest in you. Every time founders, I say, I love what you're working on. It's not in our thesis. I can't invest. You're too late. It's wrong vertical, whatever it is. And they say, well, do you know any other investors that you could introduce me to? And the answer is almost always, there's some outliers, but almost always no. Because if I tell an investor, hey, I met this company, they're really cool. Are you investing? No, I'm not investing. Okay, well, I'm going to see 1,000 deals this year. Bring me the deals that you are going to invest in too. Because if I'm an active investor, I need to cut through the noise. And so when one investor introduces somebody to another investor, the presumption is I'm introducing you because this is a really good deal. It's so good, I'm going to invest. If it's so good, why aren't I investing? And that baggage comes with that introduction. Sometimes it makes sense because it's just such a fit. Like one investor I often refer deals to, because hard tech, like deep, like there's only a few investors that really understand that. And even though I'm technical, I'm not a deep tech investor. That one makes sense because it's so plainly a good fit for them and so plainly not a good fit for me. But for lots and lots of more generalist investors, that's a really hard distinction to make. And so, the people to ask for introductions to investors are your mentors and advisors. If you have investors that they do have, it's really clear lines, like they could never invest in you. Like my LPs would never let me invest in that. If I invested in that, I probably wouldn't raise fund too. Like, well, you said you're going to raise this to do that, and now you're doing this other thing that's out in right field. So, fund and VC investors have to be careful about that. So finding introductions to good fit investors is the key. Often, and even in Techstars, investor or founders, they start with the spreadsheet. When they try to put 100 names on the spreadsheet, and usually when I work with them, my first pass is, who can I take off of this list? Not who can I introduce you to. Who do I know that's either not investing in that, not investing at your stage, not investing this size? Sometimes I'll make introductions just so they can get to know them. Like Techstars has an aphorism: if you want help, ask for money. If you want money, ask for help. So in those cases, sometimes I can make an introduction, not for the purpose of fundraising, but just so they can start to build a relationship, get some feedback, be on the radar for the next round, that sort of thing. So let's talk now about milestones, which is really, really the core. You've identified some investors that you think are a good fit, and you're going to pitch to them. You need to explain the market and the product and your customer and your revenue model and things like that. But don't neglect the milestones and the model that you have that shows that it's a cogent story that you could get there. When you pitch to an investor and they say, okay, this is really great, we go back and talk to the team, and maybe they want to do some research on your customers, your market, or whatever. Go through the diligence process. Yes, we check the bank statement to make sure there's no fraud. We want to see the formation docs. Are there contracts that you've committed the company to? There's some formal stuff. It's days worth of research to figure out, are there any skeletons in the closet? The real challenge is, can these founders get where they say they're going to go? Because they're not telling a cogent story. Founders almost never, ever tell a cogent story. They tell a vision story, they tell a customer story, they tell a marketing story, but they don't tell a cogent story. Cogent story is one in which you say, our milestone, we're raising for a purpose. The purpose of this raise is to reach this milestone. And it's one thing, maybe two, hopefully one, certainly no more than two. And it's quantified. It's a number, it's a thing that you can measure. And it's going to happen on a very specific date, 5 p.m., March 4th, right? That's the milestone. We're going to get 5K MRR, March 4th, 5 p.m. That's what we're aiming for. And then you can work backwards from that and you say, here's what has to be true in order for us to get there. And when the investor hears that story, like, oh, I think you could actually do that. That takes all that diligence burden away. Diligence is reverse engineering your story to see if it's cogent. And it takes weeks and months for investors to do that. So you can shortcut that by doing everything that you're doing now to tell this grand story about your startup and why you're the right team, why this is the right moment, and that's the right product for that market to solve that problem, and blah, blah, blah. But absolutely also tell them, we're raising 500K or 2 million or whatever, because we think we can reach this milestone on that date. Now, if you're early, that milestone should not be more than 6 months out. And it shouldn't be less than 4. The reason for that is, if it's strategic, if it's the thing that's going to unlock, a strategic milestone is not a thing that you think you could get to that would be good, or a thing that you could get to that you think would increase some metric. That may or may not be a strategic metric, right? That good thing may or may not be strategic for the company. A strategic milestone unlocks something material for the company, for some next thing that's going to happen. And you can talk about it in terms of a quantified metric that you're going to reach. And when you reach that, that will allow you to do this next thing that your next investors will say, oh, that's interesting that you got there. They're going to want to know your next milestone, but at least you show up for your next round of funding with the milestone that those investors will care about, right? If you've fundraised at all, I am certain that you've heard investors say, love what you're working on, you're a little early, here's what we'd like to see. What that means, translated, is we're not going to invest. That's all that means. Whatever they told you, like the thing they'd like to see, if you do that thing, they're not saying we'll invest if you get there, unless they, which they won't do, unless they sign something that says, if you get to 50,000 customers or 5K MRR or whatever, then we'll invest. They won't do that. They're going to tell you something to give you some flavor, kind of directionally where they think you ought to be before you're interesting to them. But even when you get there, that just gives you entry into their diligence process, right? That's not a commitment. So the thing that you should hear when a founder says, love what you're working on, here's what we'd like to see, keep us on your update list, is we're not going to invest. And that's all. There's nothing else. That doesn't mean anything else except you're not fundable to us right now. The feedback that you get from them, if they do give you some milestone they think would be good for you to get, that's great. Take that in as a founder, take what you hear from all the mentors, advisors, investors that you talk to, and you take that in and you assimilate that and you figure out what you're going to do next. But that is not a commitment to invest. It's probably would be a good making quality of your company if you were to achieve the thing that they said. But just know, all that matters is, are they going to invest or not? And what that means is we're not going to invest. So for you as a founder, the way that you cut through that time, and time is pound for pound, time is absolutely your biggest enemy. It's what's going to kill you. Time more often than not is what dooms a startup. You're all smart, you're all working on interesting things, probably solve an interesting problem. If you had infinite time, I would never bet against you, but you don't. You have a very, very limited amount of time. And if you don't get there fast enough, lots and lots of things wear out. Everybody's patience wears out. Your runway runs out. Your relationships run out. Lots of things run out. And so you have to get there quickly. So, saving time and mental energy on fundraising is not just, oh, wouldn't that be nice if it was just easier to do? No, it's fundamental to your survival. You have to, if you're not ready to raise, it's gonna take you 6 months to raise, you should not be raising. 100% stop raising money. If you've already raised for 6 months and you don't see any glimmers of hope, stop raising. Figure out what it is these investors want to see and then build that. Get to that traction, that milestone, and then raise again. So when you build that milestone and you say, we're gonna raise this much money, $500,000, $1 million, $2 million, whatever it is, you say, we're going to get to 10K MRR, because we think if we get to 10K MRR, that will unlock this next market. We know that this other big strategic partner that we want to work with, they won't work with us until we have this many customers. We have an LOI from them that says if we get to that many customers, then they'll work with us. Like, that's a great inflection point. That's a milestone that if you were to reach that, that would unlock something material for the company. And that's what your investors will love to hear. Now, it's still going to be 4 to 6 months out. If it's more than 6 months, look, your headlights only go out so far. Investors, we see projections all the time. Here's my 3-year forecast. Okay, the only thing I know about any forecast that any founder shows me is that it's not going to happen. That's the only thing I can extrapolate from that. Yeah, tell me it's a big market. I get that. Your hockey stick won't happen. It's never happens. The purpose for that model, that projection, is for me to see how you think about your business. Are you realistic about the way you're going to approach this market? Is your go-to-market strategy reasonable so that when you tell me how you're going to do it with this channel and these tactics and these conversion rates, like you've thought through that enough so that I should believe that that will happen? So the later stages of diligence is often, continuing to reverse engineer that story, but in more and more and more detail. So if you don't provide them with a model that shows your assumptions quantified over time, they're going to go back and they're going to have an associate or an analyst at their firm, or they're going to do it themselves. And they're going to try to figure out, gosh, they said they're raising $1 million so they can go do this thing. And they say they're going to get there, but can they really? Because mostly they don't. It's hard. Everything takes longer than you think. Everything's more expensive than you think. Things happen that are out of your control. So if fundamentally your assumptions are not rational, reasonable, achievable, that smart people who understand your business, if they don't agree with your assumptions that you can get that many customers at that velocity through that channel using those tactics, they're not going to invest. They might like what you're doing. They might like you. And what they're going to say is, love what you're working on. You're a little early. Keep us on your update list. Here's what we'd like to see. Those kinds of things. If you instead, though, if you say, well, here we are today, we're going to raise 500K and we're going to spend it this way. We're going to spend it on this channel using these tactics. And these are our assumptions about how well that's going to go and how long it's going to take and how much it's going to cost. And all of those assumptions look rational. It's like, oh, I think you could do that. You don't have any assumption, like, when I need to start and say, oh, we've never spent a dollar on marketing, so that's why our CAC is going to be 0 for a long time. Like, that is not an answer, right? The word of mouth, like, people love us so much, we're going to go viral, and that's how we're going to grow. That is not, you can't support that, right? Unless you can. But if you can, you will only be able to support that in a spreadsheet. You must have a spreadsheet. If you don't have a spreadsheet, you don't have a cogent story. I can tell you that right now. Cogent stories for a startup don't happen in your head. They don't happen in a Word document. They happen in a spreadsheet. You have to quantify the assumptions that you're making. Those assumptions have to be the kinds of assumptions that if smart people who understood that assumption would say, oh yeah, that's about right. Yeah, that'll probably happen that way. If you say you have a $9 customer acquisition cost, and no one in your industry has ever had a $9 acquisition cost, and it's more likely to be $39, and all your mentors and advisors say, it's probably not going to be 9. Yeah, but everybody loves us so much, and we didn't spend any money on marketing already, and look where we are. Like, it's going to be 9. If you stick to that, you are unlikely to raise money. And this is one little nit out of a big basket of nits that investors look at when they decide if they're going to invest in a company. So those assumptions that you make, you should quantify all of them and you should validate them. Just because you believe them or you had some experience doesn't mean investors are going to believe them, and because they haven't had that experience. So that's what mentors and advisors are for. And often, startups, including myself, back in the day, I didn't know who I should have on my advisory board. I thought I was supposed to have, big fancy people that people would recognize. Oh, I got this guy and that gal, and like, isn't it great? They all believe in us. I didn't realize at the time that I'm probably going to get no help from them at all. The fact that they're so highly sought after and interesting means they don't have very much time for me. And by the way, because I can't get very much time from them and I can't get tactical, roll up your sleeves help with things like this, they're probably not going to be the one I can spend hours with validating that my model is likely to work. So you need to find advisors who understand the things that you have gaps with. And you won't really know what your gaps are until you try to tell a cogent story. That if you start to say, well, here's our customer, we're going to get them this way, it's going to cost this much. Our product, our roadmap looks like this, it's going to cost us that much to build this product. This is why we should build this feature first and that feature next. This is why we should stop building and just sell, and we're going to do it this way. All those assumptions are things that have all been done before. You're going to do very little as a startup founder that has not already been done by some other founder and hasn't been seen and understood by some other investor. You need to talk to them. You need to build relationships with them so that you can get them to help you validate. We think we're going to use LinkedIn and we're going to do campaigns like this and da-da-da. Or we think we should build product that's this robust, because that's what our customers need. And you need to get that feedback from people who understand what you're doing so they can tell you, no, stop building. You have a product that solves a problem for some people, not for everybody. It's not the Taj Mahal, but right now you could get paying customers with just what you have. So stop building your product. Go get the customers that this is right for right now. And what that does is it shows investors that you actually want to build a business, that you're not just building a product, because we see a lot of founders who just want to build the best product. First of all, the best product doesn't always win, and the product is almost never the thing that determines whether or not you're going to be successful. As I said, unless it's hard tech, some things that require science. In healthcare, there's a bunch of those. There's product risk, but most startups, there's not a lot of product risk. Even if there's some, usually the team, if it's a good team, they're the kind of team that could solve that product risk. If you have a team that can't solve the product risk and you need to somehow hire out to a team that can solve that product risk, that's a challenging position to be in as a startup. Because investors, they want the founding team to be able to solve for much of the risk they see in the company. So by having a cogent story, by saying we're raising 500K, we're going to get to 5K MRR in 5 months, 3 days, and 17 hours. That's the reason it has to be so precise. The investors aren't going to care if it's precise. In fact, they might look at you a little weird if you say, yeah, 5 p.m. on this date, we're going to have 5K MRR. You don't have to tell the investor that. You can't know if you can really get there unless you tie it to a very specific time. Because what we do as founders is say, oh yeah, next year, like Q1, like, oh, we'll get there in Q1. You have no way to track if you're actually going to get there or not, because you don't have any metrics that have to be true in order for you to get there. So the discipline of tying it to a date and a time makes you go, okay, now what has to be true? Because I don't want it to slip. I don't want to show up on March 4th at 5 p.m. and only have 2K MRR, which, by the way, if I have tied it to a day and I'm tracking my results, I can see, 2 months ahead of time, I am not going to get there. So I should stop saying and stop thinking that I'm going to get to 5K MRR by March 4th. The alternative is change your assumptions, try a different channel, different tactic, something else that you think can make up for that lost time. That's really hard. I hope that if you get in that situation, you're able to do that. Mostly it doesn't happen that way. And mostly founders don't see that coming. And so they show up, they were planning to raise, nothing tells them that they shouldn't keep raising. So they show up without the milestone that they thought they could get. Like 4 months ago, they were talking about, oh, we're going to get to 5K MRR. And they kept saying it and kept saying it. But, a month ahead of that milestone, they're at 2K. They're not going to make 3K MRR more in the next month. It's not going to happen. So they should stop thinking it's going to happen. They should stop telling investors it's going to happen, because you're putting yourself into wait and see mode. Like anytime you say, hey, here's where we're going to be next. right? Investors look at that and go, huh, I wonder if they will. If they do, that's a good sign. That's a founder who says, here's what we're going to do next, and then they do it. Which, by the way, you should be, if you're fundraising, you should have a monthly update at least. Monthly update, here's what we did, here's what we're working on now, here's what we're going to do next. And your next update better say, remember when we said we're going to do that? Well, we did that, and here's what's going to be next. That relationship, that communication relationship with that investor is very, very important. If they see that you're executing, you're doing the things that you said you were going to do, that adds to the cogency of your story. It makes you more believable. It sounds like you're more rational and logical, and you think things out, and you're going to do that, and then you do it. You perform, you execute. So let's talk about execution for a second, because it's a big thing for investors. And you'll hear investors and experienced founders say this stuff all the time. Like, what matters? Does product matter? No, product doesn't matter. What matters? Execution. So I don't know. I'd be curious. I won't bog us down here. But do you guys know how to use the hand wave on Zoom? If you do, wave if you think you know what execution means. Any hands? Anybody know what execution means? It's like the most important thing. Investors talk about it all the time. Like, product doesn't matter. It's execute. Can you execute? Great founders, they execute. Do you know what execution means? Lots of founders think, and maybe nobody here, but other founders, they think that execution means you work hard and you work fast in a direction and you make progress. That's execution. Like, you're getting it done. That's execution. And that's not execution. Execution is knowing where you need to be next, so that the things that you're working hard and fast on are all and only the things that will get you to the spot you need to be next. You can't be in 7 spots next. You need to find the right next milestone. Not like some good thing that if you got there, that'd be great and everybody would like it, you'd like it, and your investors like it. That's not a milestone. That's not a strategic milestone. Strategic milestone is the right next place you should be, so that every day, you and your founding team, you wake up and you know what your North Star is. You know what you need to work on today. There's so many distractions in the startup world. There's no time to get anything done. You could never get everything you need done. You just can't do it. So how do you focus? Anybody ever had a founder, a mentor, advisor, investor tell you how important focus is? Sure, we all do. And it is critical. But what do you focus on? What if you're focusing on the wrong thing? What if you think you're focusing because you're doing this thing and you're saying no to a lot of stuff, but that thing isn't the thing that will get you to a strategic milestone? Then you're probably focused, but you're focused on the wrong thing. And the remedy for that is to know where you should be next, 4 to 6 months out, specific day and time. If you can answer that question of what your next strategic milestone is and when you need to get there, then you'll know if you're executing. Every day you get up, the team is all aligned. It's not uncommon for a CEO and a CTO to disagree. The CTO generally wants to build more product. The CTO or the CEO generally wants to do more business development, try to get customers and things like that, wants to do more marketing and sales. But what if you woke up every day and everybody had the same milestone in mind, right? Everybody who was running a team, everybody who was running a process, everybody who was working with anyone associated with the company, opportunities incoming from potential partners. Like, when do you say no? You say no if that partnership doesn't move you forward to that next milestone, or if you think, or other mentors, advisors think it would slow you down and make you not hit that next right strategic milestone. Startups are built lily pad by lily pad. You don't get to jump across the pond. Great to have vision, know where you're going, that's big, but you gotta have your feet on the ground. Head in the clouds, feet on the ground. You better be able to tell the vision story about how this could be big and important and useful, but if you can't tell me what the next lily pad is you need to land on so that you can be in a position to get to the next lily pad, your opportunity for success is pretty low. The success rate in startups is bad. I don't know what your number is, Cameron, Rick, but for me, I got to go 95% failure. Like, first few years. But even great companies with great product and a great market, a great team, funding, they still fail. So how do you get yourself in the 5%? I haven't found a better way. If you know a better way, please tell me. There is no better way, in my view, than to build a cogent story, to figure out what milestone you need to get to next, marshal all your resources around that. But it has to be strategic. It has to unlock the next thing for the company. And you absolutely must be able to tell a cogent story. And the only way that you do that is you quantify the assumptions, the things that would have to be true in order for you to get there, and you validate that those assumptions are reasonable, rational, compelling, likely to happen over time. If you don't do it over time, you
I swear I didn't kick him out. I think he must have dropped off there. In terms of hit before he hops back on, I think we'll be transitioning to Q&A shortly. So if you have any questions, kind of get those primed for that. Just a couple of the things that are standing out to me. One, just really thinking, obviously hearing the cogent element of it, but really being specific on that next strategic milestone is a really key element to the fundraising groundwork process, right? And that's where you're looking at what's the diligence of how you ultimately are tackling the assumptions that lead into order of achieving that, actually. And then I like that kind of definition around execution, because oftentimes we do a lot of that. We call it like make work. So we do things that feel productive, but we kind of working and building things that don't actually move us in that right direction to achieving that strategic milestone. So Bob was buying us some time there. We have about 9 minutes. So I know you got kicked off there for whatever reason, but you're back in the space, and turn it back to you.
Well, good. Thank you. And sorry about that. Can you hear me okay?
Can hear you well. Yeah.
Very good. Yeah. So can you remind me where we left off? I was jostling to get back on, and I forgot where we were at. Cogent story.
Lily pad.
So, yeah, you were kind of in the lily pad story of
Yes.
head in the clouds, feet on the ground, working through.
Thank you. Yes,
strategic
yes.
I wrote
milestones
that
and
down. It was a great quote.
Good, good. Yeah, so focus is ridiculously important. And in fact, on that note, there's an investor in Seattle. His name is T.A. McCann. Brilliant guy. He was a founder, product founder, sold his company, became an investor, works for now with as a partner in one of the best startup studios I know of in the world, called Pioneer Square Labs. He wrote a blog post that I encourage all of you to go read. He created an acronym to help, when he was a mentor, to help founders wrap their head around what focus means and how to avoid distraction. And the acronym is ITINDY, which stands for Important Things I'm Not Doing Yet. As founders, there's no shortage of amazing ideas and opportunities and things you could do. You absolutely cannot do them all. And if you have to have some way to give yourself permission to not do something. And so find his blog post, read his recommendation. It's very, very good. We teach it to everybody in our accelerator. And I make sure whenever I invest in a company directly that, I mention to them that they should just take 5 minutes and go read that. He has a very good prescription for how to avoid losing focus. So that focus part, comes in, it can be because there's just so much incoming, so many ideas, but it can also be just because the team is not aligned on where you should be going. And it's very, very common for teams to be misaligned. There's overlap for sure, but they don't always agree if that's the right direction for the company, if that's the right product feature or the right customer or channel or whatever it is. And using this approach of building a cogent story, it's not like the CEO should build the story that they like. That's why cogency is such a superpower. It's compelling to the mind. It's rational. If you have a CEO and a CTO, and if you present them both, and a designer and anyone else in the company, if you present them with a cogent story, they must assent to the cogent story or provide an alternative cogent story. And there's usually only one. You can say, well, we can change our objectives and what we want to achieve, so we're going to change our story that way. But once you have agreed on that's what we want to achieve, and you work it backwards to see how you could get there, if you have something that you can tell a cogent story about how you could get there,
That is gold. The vast majority of startups never ever do this, and they struggle in lots of different ways. If you have the opportunity to get everybody aligned on what the North Star is, that thing that if you achieved it, it would unlock the next thing for the company, then all of a sudden the CTO wants to build all and only the functionality that will get you there. Wants to do all and only the the tech that will, and wants to hire the resources that will solve for that model that shows if we did these things like this, we'd get there, right? So it's a great way to align the team. And as an investor, if you're raising more than $1 million, a couple $1 million, if you're into seed or Series A, you're probably going to meet more than one investor in the fund or the VC, and they're probably going to talk to you independently. And the reason they do that is they want to see, is everybody aligned? Are you all rowing in the same direction? Often it's not the case. This is one great way to get everybody rowing in the same direction. Tactically now, let me just say a few words about how you build this story. So the story, as I mentioned before, it has to happen in a spreadsheet. It is a model. A cogent story is just a polite way to say that you've quantified your assumptions, that they make sense over time, and that smart people who understand your business agree that if you did those things over that time, you would get to that spot, and that spot is where you should be next. That's a cogent story. Can only happen in a spreadsheet. Can't do it in your head. Can't do it any other way. And in our accelerator, you can do it any way you want, but I'm just going to tell you, if you decide this might be interesting and you want to try it out, you don't do a monthly spreadsheet. You have 6 months worth of data. You have to do a weekly spreadsheet. The level of detail that you have to model for the assumptions, you have all kinds of things like, oh, we're going to hire an SDR. Well, when do you hire the SDR? If you say next month, like what does that mean? Are you going to hire in the first week or the fourth week? Because you have a short timeline here. If it's the fourth week, like it's still going to take, they got to put in 2 weeks notice from their last job. They got 3 weeks of onboarding to learn your product. It's going to take them 3 more weeks just to get good at what they do and be productive and delivering on what you hope to get from them. So if you say we're going to hire an SDR month 2, that's not going to, what does that mean? It's almost meaningless. It tells me like you think SDR is a good way for you to do sales. I get that. But are you going to get to this milestone in 6 months, and you tell me you're going to hire that SDR next month, and then you start putting in your model the production of that SDR as to start, like, hire them, and then they do this many calls and they get this many demos set up or whatever it is, and it starts right after you said you were going to hire them. That's not going to happen. It doesn't work that way. If you haven't already found the SDR, it could take you 2 weeks just to get the job description done. And then you're going to look at candidates and you're going to ask for referrals, and that's another month. And then you finally get a few candidates, and 2 weeks of, figuring out which one of those you want. And the one that you want has a job and's got to put in 2 weeks notice. And then you got the onboarding and training, get it out, right? It could be 3 months, 4 months from being productive. So if your cogent story uses an SDR as part of your sales model, you're at least 3 months from even having a productive person in that position. So if your model, your cogent story says you're going to start using an SDR right away, and you're going to get this many, closed sales because you have this SDR model, you're probably not gonna, and you're going to show up talking to investors about a milestone that you're not going to be able to reach. And all those investors are going to be in wait and see mode. It's like, oh, you say you're going to do that. Sounds great. I don't see a compelling cogent story about how you're going to do that. So I'm just going to wait and see. I'll watch you. Keep me on your update list. I like what you're doing. Here's what I like to see. Now I'm going to watch. And I'm going to wait. I'm going to see if you do it. And if you do it, great. We can continue the conversation. But if you don't, then I'm glad that I didn't, take that extra risk. And by the way, even if you do it, it's not like your valuation is going to go up in 2 months, right? Unless a miracle happens, right? You land some massive client who immediately signs a contract, and then maybe you can change your fundraising round. So for investors, timing is part of their risk mitigation. Like, it's not whether or not I'm going to invest in you. I might want to invest in you. When should I invest now? Are you really not going to take my check if I wait 3 months to see that you got there? If you don't tell me a cogent story, then I'm like, oh my God, you are going to do it. Like everything you said you're going to do, I believe you have the talent. I believe you have the resources. That channel's the right channel, that tactic, those conversion rate. That's exactly what I would expect you to see you do. Wow, I think you could actually do that. Okay, I'll invest now. I don't have to wait. You told me the cogent story that took that risk away. If you don't tell me that story, then I have to wait and see. Because most of the founders that we see don't actually do the thing that they said they were going to do. It's not because they're bad people and they lied. It's because it's hard, right? And if you, there's so many moving pieces that if you don't have a cogent story, it's really hard for an investor to have confidence that you've thought about the things that will be impactful to you reaching that milestone. Because what we see as a pattern as investors is lots and lots and lots of founders who run out of time, run out of money, things don't go like they said they were going to go. Stuff happens. So the remedy for fundraising, build a cogent story. Cogent story includes, here's the investors I'm going to invest in and why. Here's the story I'm going to tell them. It's cogent, it's quantifiable, it's validated, shows that we're going to be at a place that investor thinks you should be at. Important note, when you pick a strategic milestone, you shouldn't pick it because you think that's the right next place for the company. Okay, great. If investors will agree with you, then go do that. But if you think this is the right thing we should do next, and investors disagree, like, yeah, I think I get it, that's a good thing, but that's not going to be strategic for you. That's not going to unlock your next round of funding. Then it's the wrong one. This is the case where the investors are right. Unless you don't need to raise money. If you don't need to raise money, go build the thing you want to build, and you're not accountable to anybody. But if you want to be a venture scale startup and you're going to raise from venture capital investors, angels, VCs, funds, they have to agree with you that that's the right next thing for you to do. And if they disagree, they're less likely to invest. So I just talked for a really long time. And we could take a minute maybe if there's any questions or whatnot. I'm happy to go any direction you'd like to go, Cameron.
Perfect. Sounds good. So we are at time, so just want to let all of you know here. So feel free to hop off if you have to. I would say I have a little bit of time for us to stay on if you have some questions for Bob or want to work through that. That's totally a-okay with me. So I will pause here and see if anyone has any questions that they would like to dig into. Feel free to use the raise hand or unmute and just ask away or throw it in the chat. You were kind of, when you were talking about the spreadsheet and breaking it into a weekly element, it kind of made me think of the entrepreneurial operating system. So Traction, is that a similar kind of methodology and framework related to that?
Yeah, there are some elements of that I like. I think, the approach that we take, it overlaps with a lot of different things. But the cogency is the thing, right? So you can say, and in fact, I think various metrics frameworks, KPIs and such are actually a danger to early stage. I don't think you should have KPIs. If you want to track your progress, 30, 60, 90-day plans, I think that's great. There's nothing about most metrics frameworks that help you figure out if the thing that you're tracking, even though it's a thing and you could track it and you're doing good and you're getting there, if that's not the right thing to track, you can get a false sense of security because you know what your KPIs are, and you're executing your KPIs and you're getting there, and then you show up, and there's nothing about a KPI that tells you if that's the right thing to work on. It just tells you that that's the thing you're working on, and you measure your progress toward achieving it. You have to take a higher level view. Venture scale startups are not, Fortune 500 companies. KPIs and the rest, those are great. SMART goals, those are great if you're Boeing or, any other big company. Because that's what they're built for. Most of these frameworks, the startup operating system aside, that one's, purpose built for startups. But even lean came from lean manufacturing. Lean, by the way, is awesome. If you're not doing it, you should do it, but it is not the answer. You should do it after you've decided that that's where we need to be next, and that's our right next milestone, then lean can help you as a methodology to get to that thing. But lean will not tell you if you're working on the right thing. It will just tell you a way to work on the thing that you want to work on. The groundwork framework, number one, wants to make sure you're going to achieve the right thing in the right amount of time. And time is as I mentioned before, it's the biggest enemy of startups. And if you're, whatever you do, if you're not factoring in time as one of the most important elements of what you're trying to figure out, how to model your business and to chart your course, then you're missing it. And, after a while, a stink gets on the fish, right? You might be onto something, great idea, market, all the things are really great, but if it takes you too long to get there, that puts investors in wait and see mode too. It's like, well, if it were so great and you were such a great team and everything was so great about this, wouldn't you already have gotten there? Now, a lot of things are out of control. There's a lot of things that happen. It doesn't mean that the team's not a great team and the product's not great and the market's not great. It just means that there's a flag that it's taking so long. Startups are hard, even when you have a tailwind. If you have a headwind, super, super hard. So an indication that there's a headwind is it seems like it's taking more time than it should to get, you missed a couple of things you said you're going to do. Normally we see a company like be able to build a product in this many months or to get their first customer in this amount of time. And if it starts to take longer than that, it does start to send a message to investors. So none of the other frameworks will help you figure that out. If you have some other framework you like you can adapt some of the elements, like, the validation, the ways in which you validate those assumptions that get to the strategic milestone, the thing that unlocks the next round of funding and that the investors would agree is the right next thing for you to achieve. Get there any way you want. I'm just telling you, if you're not using a spreadsheet, you're gonna struggle. If you're not quantifying those assumptions in a spreadsheet, validating them and updating them as you learn, the chances that you're going to get to the spot that you want to be at go down a lot.
Looks like Renee has a hand up.
Bob, thank you for your presentation. There was a lot of great.
Oh, I'm sorry. Hang on one second. Let's see. So I'm at a conference, I think I mentioned, and they're tearing down the room around me now. We got about an hour break while they were on lunch. So I'm just going to try to make a little adjustment right here so I can hear you. Can you hear me okay?
Yep,
we can hear you.
well.
Okay. Let me just figure out how I can hear you better. So I'm going to switch my video off. Boom. And I'm going to change my audio. Okay. Let me see. Go ahead and say something. Let me see if I can hear you.
Can you hear me okay?
Oh, yes, I can hear you great now.
Okay, good. Well, what I was saying was thank you for your talk this afternoon. You gave me a lot of references to look back on and work my way through. But here is my question. I have an app that I've been working on for a year, and we're getting ready to drop it in a beta environment here in the Sacramento area. The goal is to see the app scale to a national level. What would be a reasonable time frame for me to go from lily pad to lily pad to get that accomplished?
Great. So let me ask you a couple questions. Generally, what market is this in healthcare? Is this consumer? Is it B2B? Or is it B2C? Who's the customer? Just super high level. Who are you building this app for? And what's the problem set?
So the app, the best way to describe the app to you simply is think of it as Amazon for care. And all of the care providers on the app are vetted annually providers. So it's cradle to grave care with a vetted background. And the app puts you through a series of questions and directs you to the right care resource. Um, the There's a few revenue streams. One is the provider base, and the other is the consumer base.
Okay. So the revenue model though, is it a transaction-based model? You make money when people buy care or things
The
related to
primary
care?
revenue stream will come from the providers through annual subscriptions.
Okay. And the care providers, the most likely first customers, those first care providers, do you have a sense for what practice area? Are these general practitioners, or are there specialties, or is it
Um,
just?
I'm actually trying to have a broad point of view. So I have 100 curated providers here in the Sacramento region. That's literally everything from pet care all the way through specialty practitioner care.
Okay. Well, and this is just an instinct, it could be wrong. My instinct in hearing that is you will do much better if you can focus, especially if you want to go geographically broad. And right now, if you think about the messaging that you have to create in order to get the attention of a physician or a veterinarian, the messaging is so different, right? You're going to have to generate campaigns, create marketing, messaging, and materials. The tactics will be different. The channels will be different. It's just really, really hard to do more than one thing with limited resources. So, I would suggest to think through how, if you were going to narrow your focus and figure out like who's the right first customer, right? It's if you're successful, you'll be around for a long time. That first lily pad is showing that some segment of your customers will buy the thing and use the thing in a way that can generate revenue for you. And if you have to wait for all of this diverse marketing and all these different channels with all this different messaging, different campaigns and channels, like that's really, really hard to do, and it's expensive to do. So if you could identify one ideal customer profile that you thought is the most likely, not a better customer, just the most likely to be the first customers, right? If you were to create customer profiles, a handful of them, 5, 7, 10, something like that, where you thought here are the ones who get this the most, that have the lowest barriers to whatever the sales and marketing cycle is. And anytime you're in healthcare, physicians are one of the most sought after demographics on planet Earth. People pay a lot of money to get their attention. So if you need to get their attention, that channel that you use to get their attention, it's going to have to be robust, and it's often going to be expensive. Now, you might have some secret sauce that allows you to solve for all the noise that happens in that space and the expense of overcoming that noise. But the ideal customer for you should be the one that you have a product that you've built now. Is that true? So you've been working on it for a year. You have an app that actually works. Is that right?
Yes, we're just getting ready to drop it into beta testing right now.
Okay, and does it require any network effects in order for it to work? Like, does the care provider need to get their patients to use it in order for it to be effective for them?
No. So the objective, and with regard to kind of the general message, is the Scroll.care app will actually assist in driving referrals into your business. So everyone has a pretty large spend on how to generate referrals. And the app, the beta we're running is through the Sacramento Health Underwriters Association. I have a benefits provider. They're the brokers that actually sell benefits. And so one of the brokerages have agreed to run beta in his company for me with his employees. And then if everything goes as planned, he would like to offer the app as part of his benefits package to the companies he sells to. So,
well, if that works, why would you have pet care anytime soon?
well, so again, so my avatar user is, the 43-year-old female that's at work trying to provide care for her home and her family and her kids and her parents and probably her grandparents, right? And so she's covering a whole spectrum of different types of care, right? So whether it's pet care or, someone that's going to come in and bring food to her parents, right?
Yeah.
Today, that market is filled, the whole spectrum is just filled with bad actors. And
Yeah.
Scroll.care, through the background work, should eliminate most of those bad actors and really direct the user avatar directly to vetted resources right in their marketplace.
Well, so you have an age and a gender identified as an ICP. Do you think you have a sense for what they do for a job and how many kids they have, and whether or not they're caring for a parent? Do you have other data that can help you triangulate not just on women of a certain age, because that's you still have to get the messaging right. And I do think so. In general, I'll say you're biting off a big piece that will be challenging to cut through the noise. So that in this case, it won't be the doctor's noise, but 47-year-old women are also not as sought after as physicians are, but they're still a very, very attractive demographic for lots and lots of people who want to sell things.
Mm-hmm.
So, to the extent that you can narrow your initial customer, not to 47-year-old women, but to 47-year-old women who work in tech, or 47-year-old who do these kinds of jobs, or have this dynamic about their family, so that the message that you put in front of them is likely to be one that they'll recognize immediately, right? And so, not every 47-year-old woman has a pet. So if you ever do an ad, any marketing that mentions, oh, and if you're looking for pet care, here's the way to do it, avoid the bad actors, that's not going to resonate with everybody. Right. What is the messaging, the marketing, the channel and the tactics that you can use? And you have this benefits provider who has, a bunch of customers that will put marketing in front of them. That messaging should be really, really targeted, precisely who you think your first, 1,000 customers, or I don't know what you have in mind for a customer count in the next 4 to 6 months. But if you want 10,000 customers in the next 4 to 6 months, finding a very, very precise group of 100,000, right? It's not 100 million. It's 50,000 people or 5,000 people that have something really, really unique in common, so that the messaging that you do to them when they see it, because you're going to pay for that messaging, right? And you want this to be successful for this partner, so they go, wow, actually, this really worked. We want to do more with you. And we want to be a reference client for the next, similar company that you approach, because it's working for them. It'll work for these other folks too. So you want this to be really, really effective. And generally speaking, when sales and marketing, the more narrow you can be, the better. Geographically, demographically, and in all other ways, try to use data to determine precisely who are the best first customers, not the best customers, the best first customers. And often your best first customer is not your best long-term customer, but it's the one that you have access to, that you can tell a really, really concise and precise marketing story to, and they'll go, oh, I need that. I recognize that. That's for me. As opposed to, well, here's a message. It's for everybody. You can do this, you can do that, and do the other thing. And that's a weaker message. But if you can say, here's the 100 women that we want as our first customers, and we know that they all have these 17 things in common, and they're all going to care about this one thing, then it's very inexpensive to market to just them, right? And get that early traction. So for you, those early milestones are going to be around getting not necessarily a partner like you have right now, because lots and lots of partner relationships don't turn out the way we hope they will, because the organization themselves are often less savvy about marketing, and they have lots and lots of other things. Unless you're going to add 10% to their bottom line with this, they may be distracted with other things, and it might not be a huge priority. Right. So, finding those things where you can get, early success, which almost always means go very, very, very narrow.
Okay. Thank you for your input. That's good. Thank you.
Absolutely.
So Kinsey, I see you have your hand raised. If you want to hop in, and Bob, we'd have about 5 minutes left,
that's-
because then I will have to transition. So if you have the time, would love to hear Kinsey's question, and we'll wrap up. after that.
Is it just one last question, or is there more than one?
Yeah.
Yeah, just one last one.
Okay, good.
Yeah, kind of a riff on where you're going with. So, I think a similar problem that Renee had, where we have a very large potentially addressable market, and we're trying to figure out which niche or how to focus. You gave some great techniques already, but I'd love to hear, like, if you have any other thoughts on this. And the other thing that was really helpful in what you just said was your experience kind of helped, I think, eliminate a few categories there for Renee. And I'm just wondering, to me, how can I leverage other people's experience to close off some things without having to do the research, because you just potentially saved a lot of research time with a few of your comments here that were well informed. So hopefully that makes sense.
Yeah. So, find people, a couple things. Find people who understand your business. Find other founders and even former founders, but also people on, there's a gazillion people on LinkedIn that never get hit up for anything, but they are a vast resource. So as a startup founder, if you have a question about what customer is the right customer for you, I don't know what your space is, but if you can find people who have worked at other companies that are roughly tangentially, aligned next to what you do, you can reach out to them on LinkedIn and say, hey, I saw you worked for this company. They do something we're different, but it's kind of like that. And I'm just curious, could I get 20 minutes on a Zoom call to pick your brain about this thing? We're curious about what you learned about the customers that were the most receptive to this kind of thing. So, finding just subject matter experts is a really, really good strategy generally. And also use data. So if you think about whoever you think your customers are going to be, go find as much data as you can on them so that you can, it's an exercise of triangulation. And often you don't know what you're looking for when it starts. So if you have an ICP in mind, what are all the ways, all the sources, techniques you could find just to get data about people, companies like that you could see? Are there any trends? Are there any other things that overlap? Are there any other signals? And signals is one of my favorite things, but it's hard, right? And you can get data, in various databases, and you can use various sites to get data. Signals, there's no site that I know of that has comprehensive insight on signals. So if you think about you're selling software to, I don't know what you're selling, but it's just an example. You're selling B2B software, and you can go find out which companies, if you could find out which companies use your competitor and just posted a job, posted a job on a job site looking for an expert in a different system, right? Another competitive system. That means they're looking to change, or they've already changed, right? That job post says a lot. So that's an example of a signal that's not data. But if you just think about whoever your customers are and where it is that they live, where do they spend time? What are the actions that you can see that are observable from the outside, so that you can see if there's any trends, if there's any overlap, or signals.
Thank you. Good.
Absolutely.
Appreciate it.
Awesome. Well, thank you all for being here. Thank you, Bob, for the time and going a little long here and answering those questions and digging into the framework. Some great insights, certainly in terms of that fundraising process. And I think the big takeaways are certainly having that cogent story, but really what that's focused on is kind of that strategic milestone that you're working towards, and understanding what assumptions you have leading up to that. And so aligning that to your investors and that potential pipeline. So thank you, Bob, again for coming in and speaking to that. And for those that are looking for our future sessions, we will have next week, Josh David Miller will be diving into mastering customer discovery. So that will be, I believe, Wednesday next week. And then we'll have a second session on that the following week. And then we also will be tackling IP if you're interested in delving into that work as well. So we'll be following up with the recording here and those additional resources, and appreciate the time and energy. And thank you again, Bob, and thank you all for being entrepreneurs and building your amazing businesses. All righty. Have a great one. Thank you.